All right, what we're going to do here is similar to what we did in the first chapter, except we're going to actually use a real accounting form called the General Journal, which is where we record for the very first time our transactions. So we'll talk about how to set up the General Journal. One of the most important things to remember about the General Journal is that for every recording, your debits equal your credits. So remember that the debit side is the left-hand side of the account, and the credit side is the right-hand side of the account. So every transaction has to have equal dollar amounts on the left-hand side or the right-hand side. And if it doesn't, it's going to create problems as we go farther along. We're also going to take these amounts later on, and we're going to put them into a book of accounts called the ledger, and that process is called posting. And once we've got our ledger accounts done, we're going to do a financial worksheet called a trial balance. And the trial balance is a way just to make sure that our debits and our credits are equal before we go on and get closer to producing the financial statements. That's also as far as you're to go on the by design assignment. So let's have a look at this together. Wendy Wellsummer, veterinarian, completed these transactions during January 2000 whatever. Invested $2,000 in cash as well as veterinary equipment having a $5,000 fair value. So one of the things when you're doing journal entries is to try and figure out what's the debit and what's the credit. And what you should try and do is get a couple of accounts that you're familiar with, and one of them is cash. Cash is on the asset or the left-hand side of the balance sheet. So debits or entries on the left-hand side of the account will increase your cash. So in this case, we're contributing cash and veterinary equipment to the business. So cash is going to have a debit of $2,000. And veterinary equipment is another asset, so it'll behave just like cash, is going to have a debit of $5,000. Now our credit is going to have to be equal to $5,000 plus $2,000. It's going to be $7,000, and that is going to be made to Wendy Wellsummer, owner's equity. And then we should do a brief description. Contributed cash and equipment to business. So balances, our assets are increasing, their debit entries, and our owner's equity is increasing, and that's a credit entry. Now I remember that my next entry is January the 1st, but let's go back and see what it is. Paid the annual $960 premium on malpractice insurance policy. The policy is for the year. So you might think that we'd expense this, which would actually be a debit entry, but we're going to set it up as a prepaid asset, and we'll talk about that in a bit. And we paid cash, so once again, if you remember cash, it's going to decrease if there's a credit entry, so our cash has to be the credit. And rather than prepaid asset, let's call this prepaid insurance. And for our description, we'll write purchased malpractice insurance for the year. And that's the reason we actually set this up as a prepaid asset, is because we're going to be doing financial statements every month. And if we were to record this as an expense right now, we'd have a big honkin', that's an accounting term, expense in January and then no expenses in February through December. And accountants are obsessed with getting income right, so we would greatly understate our income in January and overstate it all the other months. So what we're going to do, and we'll have a look at this later, is we're going to set this up as a prepaid asset, the argument being that we've paid for this policy in advance, but we haven't used it up yet. And then every month we'll get rid of 1 month of the prepaid asset and turn it into an expense. Let's go back and have a look at our third transaction, which is purchased on credit veterinary equipment for $8,000 and office supplies for $75,000. So this is on January 2nd, and we've got veterinary equipment, and we've got supplies. They're both assets, so a debit is going to increase them. And we're going to have a corresponding credit that's going to be equal to both of these. In this case, we're not paying for them right away, so the place that we record the money that we owe is called our accounts payable. That's going to be $875, those two amounts added together. And we can just say purchased equipment and supplies on credit. And we go look at our next entry on the 4th. Completed calving work for a client and immediately received payment of $400 cash. That's on January 4th. We get cash this time, so our debit is going to be to cash for $400. And we've done the work, so we recognize the revenue, veterinary revenue. Completed calving work. And then completed vaccination work for Frontier Poultry on credit for $700. So this time, an asset account, but our client owes us money. And the place that we list all our clients who owe us money is our accounts receivable. And that's going to be $700. And once again, we've done the work, so we recognize the revenue. And a quick description. And we're off to our next journal entry. Paid for the items purchased on credit January 2nd. So what date was that? January 10th. So on January 2nd, that was $875 we purchased. So the first thing we're going to do is we're going to reverse that accounts payable by making it a debit. That will decrease our accounts payable balance. That's for $875, and this time we are paying out cash. Or cashga. So paid for items purchased Jan 2. Running out of space, so I'm going to increase the size of my general journal. And let's see what our next entry is. January 18th, we got paid by Frontier Poultry. So now our cash is going to go up by $700. And just like we did with accounts payable, we're going to make the opposite entry for our accounts receivable. and that will eliminate the balance in our accounts receivable. So receive payment from Frontier Poultry. And our next entry is on January 22nd. And on January the 22nd, we received $1,000 in cash as a refundable deposit from a customer for dehorning services to be performed next month. So first of all, we did get cash, so our cash is going to go up by $1,000. Our credit would normally be to revenue, but we haven't done the work yet. So we're going to call this account unearned revenue. You can call it unearned veterinary revenue. And it's for $1,000. This is a liability account because we've got the money showing, but it misstates our financial position because we still haven't done the work. So we record the work as a liability. So received deposit for dehorning work. And then I think our next transaction is going to be on the 24th. I'm going to need a little bit more space. And on the 24th, Wendy Wellsummer withdrew $100 cash from the practice to pay personal expenses. So the fact that it's personal expenses means that it's not a business expense, but it's a drawing. So record that as a drawing that will eventually get closed into owner's equity. And withdrew 100 for personal use. Now we're getting near the end of the month. On the 30th, we're going to record our insurance expense for the month. So this is actually an adjusting entry, and we wouldn't normally do this here. We'd wait till after we'd done our trial balance and then do the adjustments. But spoiler alert, we'll do it right here. So we've got an insurance expense, and we're going to reduce our prepaid asset. So that's the one I know. We had a prepaid asset called prepaid insurance. And I want to reduce that. To set it up, I debited it. To reduce it, I'm going to credit it. And it's 1 month, so I'm going to do the calculation in Excel. It's awesome. It's 960 divided by 12. So I'm going to have my prepaid insurance reduced by $80, and the other side is going to be an insurance expense. And that's also going to be $80. I don't know why the format's doing that. And then January the 30th, again, our very last transaction of the month. So I divided by 12. Why did I do that again? Because there's 12 months in a year, and I wanted 1 month of insurance expense. Owe employees $1,200 for salaries that have not yet been paid. Once again, normally we wouldn't set this up. So what we're going to do is we're going to have a salaries expense, and we're going to have salaries payable, which is a liability account. So this is something we do to get our expenses up to date before we do financial statements. Normally we do this in the adjustments, but we're doing it now as kind of a spoiler. So, owed salary to employees. And I better put a description up here. To record 1 month of insurance expense. Okay, so we owe $1,200 to the employees, and we'll set that up as a liability account called salaries payable. Normally we wouldn't do this because we pay our employees usually twice a month or every 2 weeks, and we just record the expense when they get paid. What's happening here is we want to do our financial statements at the end of January, and at the end of January it's not a payday. So our employees have done some work for us that we haven't been paid, so we're setting this up to do that. We'd only do this just before we did our financial statements. Otherwise, it's fine just to record the expense as we make the payments. And that's it for the general journal, almost. If we go up here, we see there's this reference, and we'll look at this reference in the second part of this exercise when we post these to the general ledger.